Okay, so now we're going to look at question 7.2. So I want you to take out your workbook and then we'll work through the information that they've given you. I want you to make notes as we go through it so that you can see how you're supposed to answer this when you get a test or an exam. Okay, so the first thing we always do is we go to the required. So they ask you in this question, calculate the taxable capital gain or assessed loss for the period ending 28 February 2021. Okay, so if the period ends 28 February 2021, that means our year runs from 1 March 2020 up to 28 Feb 2021. So for a 12-month period. And I normally write this down so that if there's things that overlap on different periods, that I can pick it up that way. Okay, now this is just focusing on capital gains. In the exam, they will include that as part of a question. Okay, so this would be incorporated into one big question. They tell you that Sitsit Pty Limited manufactures and sells plastic chairs. So they manufacture and sell plastic chairs, which means if we had more information, you would potentially actually have had a Section 12C allowance because of the fact that we are dealing with manufacturing assets. They tell you your company's factory building was destroyed in a fire on 15 June 2020. So in our year, our factory got destroyed. Now this is an involuntary disposal. So we did not want to dispose it because it burnt down. It is viewed as if I've disposed of it now. And we received the indemnity payment of 3.85 million from the insurance company. So that is your proceeds amount. Okay? Are you with me? We're on page 113. You have it in front of you now. Okay, so that indemnity payment is seen as if that is the amount that you've sold that asset for. But as soon as we think about factory building, we know it's part of manufacture, so we would have received a capital allowance. So the other thing that needs to then pop up in your mind is there potentially a recoupment that has happened due to this deemed disposal? Okay, now let's read what other information they give to us. So generally the further information would sort of help you to assess if there might potentially be a recoupment. But as soon as you see a disposal, recoupment should also be flagged. They tell you the building was acquired on 1 January 2001. So that is pre 1 October. Okay, so that's pre 1 October 2001. So that means we need to work out the valuation date value. Which we said is either the market value, time apportionment based cost, or 20% of the proceeds. So I'm just going to say, yeah, there's 3 methods. Okay, so let's see what information they give us to assess what that might be. Okay, so they said it was acquired for 2.6 million. Okay, the valuation costs was 12,000, and we determined the market value of the building as 600,000 on 1 October. Okay, so we acquired it for 2.6, which was the original cost. Valuation cost was 12,000. Okay, and then the market value was 600,000 on 1 October, and the time apportionment based cost was 0, so there was no value. Then they tell you a total capital allowance was claimed up to the date was 2.1 million. So we've already claimed 2.1 million of the 2.6 originally when we used our capital allowances. So there you already know that because we've claimed 2.1 million, we will have a recoupment. Okay. Now we have to go calculate the taxable capital gain or assessed capital loss. Okay, now what you have to do, let me just quickly share this on here. Okay, so the first thing we have to do is we have to go work out what is the pre-1 October cost, what is the post-1 October cost, to work out what is the total cost. So let me put it here from the board. That you guys can see here as well. Okay, so what you do is you say what was the original cost less any allowances. We've got pre-October 2001, we've got post-October 2001, and we've got the total. Okay, now we know before 1 October, we bought that building for 2.6 million. Okay, and we know it was on the 1st of January, so that's prior to the 1st of October. Okay, so post-October, there's nothing there, so the total cost was 2.6 million initially. Then the allowances, they tell us for this building, we claimed an allowance of 2.1 million already. Okay? We haven't claimed anything on the post. So now we say, what is the tax value? We are working out the tax value, and we need this information for the recoupment as well as when we want to work out our valuation date amounts to see if there's additional information. So we know the tax value when we disposed of it was 500,000. However, we also had other costs, which was our valuation cost after the post 1 October. So that is the cost we incurred to create the market value of 12,000 Rand, which we also include here. To get to our total costs for that asset based on this would be 512,000. Okay? So 500 pre, so that's what's left over, and 12,000 post. Okay, now when we do the recoupment, we say the recoupment is, we look at what is the proceeds value. Now in this question, the proceeds was 3.8 million. Okay, so we say that 385, that is the proceeds amount, is limited to the original cost. The 2.6 million, okay? Now, why do we say that? These allowances that we were allowed to deduct would have been based on the original cost. So even if we get more money than what it cost originally, we would not have, even if we deducted the full amount, we would only have been able to deduct 2.6 million. So that's why the recoupment is limited to the original value that you would have been able to claim the allowance on. Okay, but now we take the original value and we deduct what the tax value is at that stage. So now we deduct the 500,000, and that means our recoupment is 2.1 million, which is the allowances we've claimed. Okay, so this is included in my gross income. But why did I actually do this calculation? We said when we work out the capital gain, we need to reduce the proceeds and the base cost with whatever amount was recouped. So that's why I had to do this calculation. Okay, does that make sense? Okay, so let's just take a step back. Recoupment. That is basically recovering any capital allowances that I was allowed to previously deduct for tax purposes. Okay. Recoupment is capped at the original cost. If the original cost is less than your proceeds, you will work out the recoupment based on the cost, not the actual proceeds amount. So 3.8 million is definitely more than 2.6 million. Okay, so that means I limit the recoupment to 2.6. I only apply the 2.6. Then you deduct the tax value, so the carrying amount at the stage you dispose of it. Okay, so we already claimed 2.1 million, so there is a tax value of 500 left that we haven't claimed yet. So I deduct that 500 from the 2.6 million, which gives me a recoupment of 2.1, which is basically what I've claimed so far. Okay, so that's what I've recovered. Okay, now we work it out because the rules say when I do my capital gain or loss, I need to reduce my proceeds and my tax, my base cost with any amounts that is included as a recoupment, so that I don't get taxed twice. Okay, so that's why we did this calculation. Okay, are we okay up to here? Are you okay? Okay, let me do the rest of the steps and then let's see if it makes sense if we do the rest. Okay. Okay, now to work out the capital gains, we start with what is the proceeds. We want to know what's the base cost. And then we've got our capital gain or loss. Now in this case, we know it's gain. So our proceeds, they told us, is 3.85 million. Okay, so this is what the proceeds would have initially been. The base cost, however, because we applied it prior to 1 October, we have to apply the valuation date value to work out what is the base cost value. Okay? It is not straightforward, the 2.6 million. You have to look at the 3 items to determine what this is to work out the capital gains. Now for the proceeds, we say 2.1 million have been recovered from the recoupment. So that means our proceeds is changed to 175000. Okay, let me just unhide it here on the screen. Okay, so the proceeds is 1.75 million. Okay, now the base cost, we will have to go calculate. Now, this will be based on the valuation date method, which says we have to look at, is the proceeds more than the original cost, or is it less? Now, in this case, we know the proceeds are more than the original cost. So therefore, we can use the market value time apportionment-based cost, or 20% of the proceeds. Okay, so those are the three methods we have to determine the base cost. Sorry, I just want to unhide you on the screen as I discuss for you guys. Okay, so our market value based on the information they have given us was 600,000. Okay, so based on the information, the market value was 600,000. They said the time apportionment base cost was 0, there wasn't a value for it. Okay, so that's a 0. Now the proceeds one, this is where you need to focus based on this information. So we take the 20%, we multiply with the proceeds. Now the proceeds is what amount? Is it that the 3.8 billion or the 1.75? Okay, so the 1.75, that proceeds is the one after you've reduced it with any recoupments. Okay, so our proceeds is 1.75 million, but we deduct any costs that fall into the post-October 2001 line items. So in this scenario, it's 12,000 Rand. We deduct that from the 1.75 million. Sorry, this is a 2. And what value do you get there? So what value did we work out? No? It should be 247,600. Did you get that? Yes? No? Did you not get that value? Let me just check my calculation here. Oh, sorry, I deducted the 5. You need to deduct the full cost to the 512, which is the remaining cost. No, that was the 12,000. Sorry, it's 12,000. I know why my formula is wrong. I linked it to the wrong thing. Okay, so the amount is 347,600, right? Okay. Now, based on how it works, we as the taxpayer can go elect the highest one of those to reduce our capital gains. Now, based on those values, which one will you elect? The market value. So the market value is the higher one of the two. But remember, the market value is a value at 1 October. So now we still need to add any post-October cost to get to the correct base cost. So that means we take the 600,000 plus the 12,000 that was post 1 October to get to a base cost of 12,000. Okay? Are you okay up to there? That means our capital gains is the difference between those, which should give you a value of, let's just quickly see, 1.138 million. Okay, which is the capital gain. Okay, now normally in the question you would have other assets as well, so you would have to go add all the capital gains plus any capital losses to work out the aggregate capital gain or loss. Okay, now because of the fact this is the only capital gain we have, we say that our taxable capital gain is 80% of this 1138 million, and only that portion will be taxed. Let me just unhide here on the screen. Okay, there was no capital losses. It's assessed. I'm just going to abbreviate here, capital losses. So there was no capital loss. So that means that 1138 is applied here. And then 80% of that is included in your taxable income, which gives you a value of, just see, of 910,400. Okay, and this is included in your taxable income calculation.